This is Trepp Wire with a special guest podcast, The Road to Recovery. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And joining us today is Donald Sheets, Managing Director and member of the Management Committee at Broadshore Capital Partners. In his role as Portfolio Manager of Broadshore's Special Situations Debt Group, Don leads a team and provides oversight of research, investment sourcing, structuring, and the resolution of non-traditional and high-yield commercial real estate credit investments. Donald is appointed to the faculty of Columbia, New York University, and Auburn, where he developed and teaches at the graduate level on subjects of distressed investing, capital markets, negotiation, commercial real estate finance, and private equity. And I think I covered it all. Welcome back, Don. In nearly a year of doing pods here at Trepp, you are the first guest with a repeat performance. Congratulations.
It's an honor to come back for a second date. Usually I end up, getting the linguine all over my shirt or otherwise embarrassing myself. So thanks for actually having me back. Should be fun. And certainly the world continues to evolve since we last spoke in summer 2020. Great to be back and happy to dig in.
Don, we got to get you to trade up from the Olive Garden. I think that's the first mistake. You got to go to a better place.
I'm just a kid from Ohio. Those breadsticks get me every time. So the endless salad can't go wrong.
So I want to come in hot here with a topic that has been on everybody's minds for about a month now, and that is the rising 10-year Treasury rate. Right, we've seen it go up about 100 basis points since its trough, maybe about double from where it was around Election Day. Now we're in that 150, 160 range. You and I, Don, have gone back quite a bit. We've seen distress before in terms of the great financial crisis, and a little bit later, kind of in the oil sell-off in late 2015 and 2016. And both of those were credit events, right? People were concerned about, in the great financial crisis, everything blowing up, and in 2016, oil companies defaulting and that creating other kinds of problems. Now what we're seeing is an interest rate problem. And my first question for you is, in a rising interest rate environment, does capital reprice or does it disappear?
It's interesting. It may be a bit of a hybrid between the two, Manus, where there clearly could be some people that pause, perhaps don't pull out altogether, but maybe just anecdotally speaking, I'm certainly no expert on the Treasury market, but from what I'm seeing in terms of the recent auctions they've had and the muted turnout on a relative basis for those bonds, which continue to then escalate where rates were, it's probably a strong signal to the point of maybe some pause activity. But then, and even, Trepp validating this as well, the bid for commercial real estate paper still remains fairly strong, right? I think CMBS AAAs are still pricing well. There's a lot of bullishness around CLO issuance, which is floating rate versus fixed. But time will tell a little bit. What tends to happen in these instances is, we find ourselves in a crisis of confidence, right? And many times it's not something that is incremental. It's either on or off to the point that you're raising, where there is a bid or not much of a bid out there, and probably not much of a organized repricing. And we could see rates escalate much quicker than people are anticipating. You look at past environments when there was rate movement, and it doesn't tend to be so linear and measured over time. So it could come quicker than many of us might think.
So in your personal asset research, right, we're at 1.5 today. If you think we're 1.5 on our way to 4, you yourself, are you saying I want another 200 basis points to get into this trade if I'm looking at a distressed asset? Or do you say I'm keeping my powder dry until I see things settle down?
From when we're looking to invest, we've got a little bit of optionality because we're not necessarily writing par paper today, right? So versus the origination side, which is putting out par dollars at, a fixed rate or a floating rate, and obviously then impaired on the instrument. We're buying at a discount. we also tend to be doing activity with our investments, meaning some modifications or workouts, discounted payoffs, potentially foreclosures. So we've got a fair amount of cushion that's baked in just from this margin of safety perspective, as well as the fact that we're not kind of a set it and forget it, put the loan on and go. So we're a little less sensitive. I mean, we certainly are mindful of it, but frankly, we're not smart enough to have that crystal ball. And the thing is, if we, had waited, over the last couple of years when people were insisting that, there's got to be some rate movement, and there wasn't. In fact, it was negative. We would have really missed the ball game. So I don't want to point to kind of a fear of missing out, but at the same time, at least for our business, a little different than origination, and also. The larger area for us is to make sure that a cap rate or evaluation at the end of our investment, i.e. what's our takeout, right? So if we're buying a loan from a bank or a servicer or a life insurance company, we're not in this for the long term. And what's the availability of funds going to look like, and what's the kind of implied valuation of the asset? What kind of proceeds can that borrower get to get us out in a couple of years? That's what can become a little more complicated and could lead potentially to some more enforcement or foreclosure in our portfolio than we might have anticipated via workouts or restructuring.
So let's stick on that point for just a second. You bring up a really interesting point, something I think that's kind of undeniable for this market, that it has been value enhanced or value supported by really low rates for a really long time. So guys like you know that there's an exit ramp at the end, and even guys not like you, guys that are in the securitization business that are building warehouses, know that that ramp is there. There hasn't been a whole lot of volatility for a long time, but we saw in the great financial crisis and we saw in 2015-16, lending really dried up. The conduit lenders were not there for, in the first example, about almost 2 years, and in the second example, about a quarter. How does that fit into your calculus? The idea that maybe if things get so volatile, the capital's not there, and how do you handicap that?
It would be good for our business because when liquidity does dry up, that means that there tends to be some motivation for sellers to move situations, at a discount. So that would be, positive for flow. However, to your point, might be a negative for us finding liquidity events. Because we don't necessarily have a lot of legacy exposure right now, and we're more in buy mode than resolve mode, that could be good for us. But the ability for takeout, a lot predicated, to your point, on the value add space from a bridge loan to a bridge loan, certainly continues to happen today, and when that music might stop, TBD. And a lot of these private debt funds, which we observed clearly in the immediate collapse that we saw in spring of 2020, are highly levered entities with floating rate exposure in terms of how they typically are financed. Now, many of them have restructured, recapitalized aspects of their book, but we're still operating in an environment where private debt funds do remain highly levered. And if we see any instance where banks begin retrenching, because that's really the larger financing source in CRE, between 50 to 60% of CRE debt is on bank balance sheets, then we've got a real issue. I think it's a little less exposed to CMBS because it continues to not be as relevant clearly as it was pre-GFC. So it remains active in the market, but not nearly the effect that we might see. And it may come down to asset classes as well, and still exacerbating those assets where you can find liquidity for refinance, and those where it's going to be much more challenging, particularly if liquidity, to your point, begins constricting more.
So we were talking about this yesterday during our prep, and I'm breaking the outline early and often, as I've been known to do, and our listeners know I've been off for a couple of weeks. So in your classes, you talk about several different types of distress and what drives distressed asset. Maybe you could talk about the multiple ways that distress emerges and where you in particular find the most opportunity now and where you think it'll be in a changing rate environment.
Yeah, no, it's, I guess it gets a little bit back to the classroom. Way that I tend to open it either with our investors or with my students is talking about these 5 catalysts of what creates a distress situation. And many times people immediately think of distress starting at the property level, and that's a good instinct, right? So something happening tends to be a business plan that's behind schedule. Perhaps a large tenant has vacated unexpectedly. You could have an issue with operating expenses or capital that wasn't fully anticipated, all of which kind of are a confluence into a property level trigger that then means that there's not enough NOI or net cash flow coming from the asset to service the debt. And you'd likely have a payment default or potentially a maturity default as a result of that. So a lot of what people need to think about is that property. But you have these other catalysts that play in as well. One is a borrower catalyst. In many instances, you could have situations where you've got a corporate entity or a family where there's a fracture. It could be estate issues, could be divorces, could be a guarantor party that's deceased. And you can have catalyst into distressed or call it non-par situation based on something happening at this borrower level where the property is effectively just fine, right? We certainly saw that in some instances, pre-GFC, at GFC, post-GFC. Fraud can be another instance where you can have triggers that go across. Another catalyst is the lender, and that's one that we were just alluding to a little, where you may have a future funding obligation of TILC, good news funding, construction loan, where if a bank is or a private debt fund might be under stress as being acquired by another entity or otherwise is in recap or restructuring itself, could find lots of reasons not to fund through rebalancing or through fiat if you're basically a seized bank. And so you can have some distress that triggers out of that situation. Another is in the macroeconomy, right? And this Manus is really getting to the point that you're raising, which is the availability of funds and the cost of funds in the market. You could have a perfectly fine asset, perfectly fine borrower, no issue with the lender, but the tap is on or the tap is off for liquidity, and that tends not to be something that lasts for 30 days, but could last for several months. And you may have cost of funds changing as well, right? So that tends to be something that at maturity can lead to defaults or extensions, which obviously can trigger some aspects of distress or may force a recapitalization of the equity in order to kind of get the existing loan out and a new loan in. And last, you can have effectively a capital structure issue. And in this instance, there could be a defect in documentation. There might be an argument or litigation among various creditors within the capital stack, and kind of a mix and match there. That tends to work with another one of the catalysts in motion, but certainly can be isolated as an issue that might lead to a distress situation. So I think at our doorstep, most likely is property for sure, lodging, retail, office, front and center of what radical reshifting revenue profile might look like. We likely will have a little instance of perhaps some borrower stress as a result of parts of that, but I wouldn't say anything intrinsic to where we are. Certainly macroeconomic, meaning cost of funds, availability of funds as well. Manus is going to play in to what might create this illiquidity or some distress in the market.
So Don, it sounds like, the 5 families: property, borrower, lender, market, and administrative or capital structure. So as kind of thinking about being the student, that makes a lot of sense, because then you can go down some really serious paths on each one of those things. But I think more generally, the last time around, or the last time we had you on, I think you were talking about that you had driven already to the West Coast, or you were about to drive. I can't remember exactly, but yes. And we talked all about what was going on at the time, but give me a sense of what has changed, kind of maybe in what you're seeing in your day-to-day life, or kind of your perception of what's going on in the world. I mean, this is a super broad question, but kind of like vibe check on Don Sheets as opposed to 6 months ago when we last spoke.
Yeah, no, I've now crisscrossed the country twice on via road. So having to, 1, get out here in the first place, and then 2, organize a move on the fly from New York. So at this point, I'm pretty much dinered out. Although, which takes a lot, again, from some kid from Columbus, where diner food is pretty much you can do breakfast all day is kind of a meal. So, I would say that we continue to see one aspect I was alluding to, I think a little bit, but has continued to play out, is a little bit of head fake in the market from the sale side, meaning we continue to see lenders and counterparties that have brought some, secondary paper to the market, either quietly or even through, let's call it a brokered process, and then decide no sell. And not a no sell because the bid ask is wide. In fact, bids are coming in right where indications were given from the seller. They just pull out. And we've been involved in several situations through the fall, into 1Q, where we spent a lot of time and effort with sellers, and they're not transacting. That being said, we have transacted several times, but it continues to be something a little different than the last cycles, where we did not see as much unpredictability or fatigue that was setting in. So that's one observation.
Don, do you think that some of that is due to the epic levels of flexibility given banks and other institutions through all of this?
Could be. I mean, this is, at least in my career, the only cycle that I've seen where it's okay, according to the regulators, to kick the can, right? In fact, it's kind of the directive
Right.
to kick the can. So it certainly is going to elongate what this cycle might look like in terms of how it all gets cleaned up. But I think to your point, that likely is part of what's happening here, where I would hate to think that someone bringing something out, vexing people, and then just for a pricing exercise, isn't the case, but we've seen a lot of it over the fall.
Did you find a materially different environment after the vaccines came out than pre-vaccine? It kind of seems like if you got to November and you were holding on, and then all of a sudden you think, well, if I can hold on 6 more months, then we're going to come out of that. Did you find that more of this was happening in the last 3 or 4 months than before? So, or, are people still behaving the same way?
It was much more of a summer into early fall thing. And now we finally saw a logjam break where some trades really started getting done, into 4Q. So strangely enough, it was much earlier where we just saw the head fakes. Also part of that being that there was panic mode in March, April, May. And once May, June, July came and people realized that the stock market stabilized, they were getting, modifications done if they were private debt funds with their financing facilities, they, kind of all pulled back. I would say on an asset class, we continue to, to the point of vaccines, lodging paper remains pretty active. We're seeing a fair amount of trading activity in the lodging space. Not nearly the amount of retail that I would have expected has come out yet, at least from what we've seen. So a little counterintuitive on that.
And that seems to be dragging out quite a bit. We were talking the other day about the CMBX 6 mall portfolio, which is substantial in both size and volume. And I think only about 10 or 20% of those loans have been reappraised lower. So it's really taking a long time for that to play out. Whereas I thought that would be kind of the first thing to clear in this market, and probably to the detriment of the shorts and the happiness of the longs who keep receiving their premiums. That has taken quite a bit of time. Let's turn to the office space for just a minute. You've been down this path. The situation where a guy has lost a tenant in a stable market. What occupancies are like, the likelihood of re-tenanting a property, how long it will take, how much money you have to put into it, over the last 10 years. Now you're in a scenario where there's, a real lack of visibility into what demand will be, what supply will be, what sublet space will be. Tell me how you think about that market now. And are you even playing in it? Or are you just saying, until we get a sense of economy's opening, this is one party, I'm going to sit out?
Yeah. So, office, at least from my perspective, you have a couple different branches. One might be that, let's call it, I'll just say generically speaking, a suburban office building in perimeter of Atlanta with a, call it 1 to 200,000 square feet and a rent roll of 20 tenants, all of which are, 5,000 square feet and under for the most part. There's kind of that kind of profile, I'd have a little less confidence around. Very commodity tenants whose credit you really can't necessarily underwrite, and a CapEx profile that remains pretty ambiguous because of how that space would refashion itself potentially to stay relevant in the market. And then you might have institutional grade larger tenant office product. But again, all it takes is your 15% tenant major money center bank or whomever to basically announce sublease or that they're going to do a lot of work from home, and you've got an issue. We did go long toward the end of last year on an office tower in Houston. That was the note was being sold by an insurance company at a pretty severe discount. A very blue chip sponsor, an asset that's maybe just about 10 years old, so pretty relevant in that market. Lead gold, but 80% vacant. And from our perspective, it wasn't that we had a crystal ball of what's going to happen with oil and how's that going to play with inflation and taking some macro play. It was just really cheap on a per pound basis because it was vacant, and actually the rest of it will probably vacate in the next 2 years. It afforded some interestingly counterintuitive optionality where we could, as our liquidity for this, perhaps just find a single user, an oil co or a single building tenant or buyer, if you will, of the asset. So actually having the vacancy increased, I think, our optionality versus having something that might be half empty or 2/3 full, kind of situation. By no means, again, did we say that oil was going to double, which it has since November, and what that might mean for the Houston market and the recovery. It's not necessarily translating into a bunch of tenants taking a walk through the building because it hasn't. But at the same time, it was, look, you've got a market in Texas that is a top 5 MSA, institutional grade asset at a basis that is 25 to 30% of what the borrower paid for this 6 years ago right? So 75% discount to what they paid for this asset that long ago. In a market where, I'm pretty bullish on Texas generally in terms of growth fundamentals. So, that was a way for us to express that view. There aren't necessarily a lot of those, and I'm not pounding our chest and, I'm not saying we're not out of the woods. We still have to find a liquidity event for this asset. But office may have some different stripes, and for us, again, something that has a granular rent roll that may have some real heavy lifting to keep relevant, tougher. Strangely enough, I think vacancy in office right now, if you're an institutional asset, could be pretty interesting if you can steal it.
That's very interesting. Houston office, which really seems to be, the biggest area of distress right now. That's not where I expected you to say you were laying your chips. So now I think on the weekends you must do bull riding.
That's why he's the pro. He's right. The pro distressed asset buyer. We're just the podcasters.
We're going to learn that, Don does bull riding and cliff diving on weekends. That's, that's really kind of the center of the universe of distress, just as New York and Houston, probably Portland and Chicago are for hotels. Certainly Houston is for office and has been for a while. So I hope you guys get a 10-bagger out of this one.
We're not looking to necessarily knock a home run, but we do think, again, at this basis, it was mispriced. In what is likely to happen on a situation like this is we're not going to try to extract every dime out of the deal. If we can find a major tenant, it's probably a situation where we get that lined up and perhaps find our liquidity immediately there and not even necessarily get the tenant in place, right? Sell it with the tenant in contract and go. We're in the business of, not necessarily falling in love with the real estate, but just trying to be in the right place at the right time, with a checkbook every now and then.
So Don, coming from the other side of the equation, the investors in your fund or and yourself, what generally is the duration kind of yield or return expectations or anything like that? I mean, are we talking like high double digits? Are we talking high single digits? Like, I guess in terms of your cost of capital, what does that look like?
So we could have a performer, and that's clearly going to, yield or kind of price differently than this, for instance, NPL in Houston. So on some of the performers, we're kind of in a high single digit, unlevered profile into our, what we then call it kind of a restructuring case. And that's going to be probably like a 9 to 11 unlevered for that kind of where we think it's performing or subperforming today, probably is going to require some kind of modification activity. And then eventually get us paid off at par or a discount to par. It's going to price in that kind of high single, low double digit unlevered. And then, REO or foreclosure or, NPL, in some NPLs, we may actually get back to PL. That happens. Right. Others, we do enforcement on, is going to trade more like an equity type return, right? So we're, unlevered, low teens to mid teens for situations like that. And then we use modest leverage in place, typically at a portfolio level versus, individually to each position. So we can pick up a couple hundred basis points. We don't get exotic. We don't, do multiple turns of leverage. Maybe it's 1 to 1 or 1.5 to 1. It's certainly not 4 to 1 or 5 to 1, which you see in a lot of the new origination space.
So when you look at asset by asset categories, are there some parts of the market that you won't touch right now because you just think categorically they're overpriced and people are missing elements of risk that you guys see at this point?
Everything's got a story. So I try not to take too much of a macro brush of it because when we find the mispricing, it tends to be if other parts of the market are taking that approach, and we'll find occasionally something in the cracks that doesn't fit like that. The larger thing for us is trying to avoid right now binary outcomes on the collateral. And we may have said this in the last one, is there a reason to exist, for this asset? That's a question we continue to ask, is this asset relevant? And is there some degree of optionality still left with this asset? And that informs us more than, saying that retail's like off radar. We've had a couple very interesting retail notes across the desk, one of which in Houston, which was pulled back by the bank. But great asset, new collateral, but everyone has completely, blacklisted retail. And so we are seeing some interesting spots when it comes. We have not, again, like I mentioned, seen as much as we would have expected at this point. But we're keen to spend some time on it. I think like anything in real estate, we're going to see some things that are in favor today turn out of favor. In assets like industrial and multifamily, where you've got very strong bids, aren't immune to what happens a lot of times in this business, which is, something fundamentally changes in supply or tenant dynamics or relevance, and it gets cheap again.
Where do you think the malls go at this point? And would you be a participant in a repositioning of a mall to something other than retail? Right. We've seen, I used to call it the unicorn, that everybody would talk about these repositionings, but they would never really happen. A new mall guy would come in and buy it at 10 cents on the dollar and operate it as a mall. More recently, we've seen the industrial turnover. We've seen an office in North Carolina. We've seen people talk about turning it into multifamily housing and other things. Is that something you'd be involved in? And do you think that that's a one-off type thing that we're seeing in the news right now, or will many of these malls go down that path?
We've seen a few where they were certainly plays of busted, let's call it runoff cash in some way, and making the calculus of, for how many years do you kind of make sense of this thing, maybe try to get a re-entitlement, redevelopment plan, continue to scrape whatever positive cash flow might come. They're hyper localized. So in doing it in scale, I think would be difficult because they are so locally driven where you don't have a recipe that can be templated from deal to deal to deal. So my sense would be that if you're a money partner, having a very, on the ground local sharpshooter with you would be essential, or a long-term family office as capital that has roots in whatever that area is, and therefore has a motivation, perhaps would do some things that might look a little irrational today, but in 10 years, 15 years, turned out to be genius, but would never work for an IRR investor that is managing money for an institutional fund. So you'll probably start, seeing where it's not going to be opportunity funds or private equity funds that start backing projects like this because their cost of capital is just too high. And frankly, it's too much work. It's a lot of work to really understand what's going to happen here. It can be capital intensive, and you'll be explaining it to your investors for a while until this thing is actually done. Hyper localized. We have seen a couple here in Southern California, strangely enough. The problem with a couple of them is that it wasn't far gone enough. It was clearly not going to make it, but there was still too much kind of happening and too many tenants that were still kind of there in some way and kind of mired together. And so it wasn't an immediate land play in 2 to 3 years, for instance. So they are all a little tricky. I think ultimately there are a lot of Class C, B minus malls in hundreds and hundreds that are better served not for their use. The issue is going to be, we're seeing right now a lot of repurposing and rethinking of what real estate's going to be. We don't want to make overgeneralizations about COVID because, we could in 2 years brush off a lot of what we thought was going to be fundamental change. It's unclear really how much change there will be, but there are some tipping points on some things. I do think retail as an alternative, even if a mall is demalled, retail still has a use, right? But the universe of tenancy out there, fraction of what you can get financed today or bank on. So these land plays, they're big pieces of land that require a lot of density, and office is still being a little rethought right now in terms of what the relevance will be. And while a scrape is probably highest and best use, maybe strangely enough in some of these situations, it's single family attached housing, right? It's not really commercial real estate with perhaps ancillary commercial real estate around it, but where the housing market is today, if I was a housing developer, I'd be all over trying to find a regional mall. Oddly speaking, that might be the best use.
Got to open up a business that just does that part. We don't need to build the houses. We don't need to figure out how to build the multifamily, but we can come in, scrape this thing off the ground, make it flat land for you, maybe even do some of the entitlement work, and then hand it off to Lennar or Toll or somebody else.
Before I forget, we did this in our last podcast with Professor Sheets, and that is he puts out something quarterly, which is called Sheets. Last time we put out an offer to contact us, and we would put our listeners in touch with Don to be added to his mailing list. Is that offer still out there, Don?
Absolutely. This thing has taken on life of its own, but more than happy to have anyone just reach out. Obviously, just send us your email address and your coordinates if we can get you added there. If you don't mind having every so often this little newsletter showing up in your inbox. But yes, when I find the time, about once a quarter or so is my current schedule of getting installment out, which means that I am due to get something written. So.
Well, I do find them must reads. I found you really ahead of the curve on many predictions over the last 10 years. I do find you put them out at unusual times. I think the last one came out on New Year's Eve.
Yes.
Right? When the market shuts down and Don Sheets doesn't have to get on a plane to go see a property or go to a closing. He spends a couple days pumping these things out, and they're well worth picking up. I really enjoy them. Let me throw one more question out at you, or maybe it's a two-part question. A year from now, and you could take this anywhere you want, where are we, and what is the one thing that you don't think will be a surprise, but you think nobody in the market is really seeing right now? Is it a 4% treasury? Is it an illiquidity event? Is it real concerns about the U.S. deficit? Giving you free rein here to kind of, something that you are really concerned about that you think the market hasn't really priced in any way, shape, or form yet?
We want you to make a major prediction, and we will hold you to it next time you come on.
No, we really won't.
And it's recorded.
You can't go wrong, Don.
Yeah. I mean, what's been puzzling, and the issue with being kind of a value-based investor is having to suffer through what's the amount of wealth and kind of quote unquote value that's been created around companies that have no semblance of cash flow in the last several years, and that only becoming more exacerbated in a time where you would think that EBITDA and cash flow would be valued. And so maybe generally speaking, it's the hyper overvaluation of entities that have no present cash flow, or even going a stretch further, path to cash flow, other than kind of being absorbed by another company, or so I wouldn't say broadly speaking tech, because there's plenty of tech that has path to cash flow and existing cash flow, but there's certainly within that universe a number of players that fundamentally you look and you're like, what's driving this? It's other than it's pure speculation and pure mania. Again, call me old school, but cryptocurrencies that have no fundamental underpinning, going to valuations that you look and it's like, I can't explain remotely what's happening here, and why we're seeing this kind of run up in value. So I don't know. It translates into, is there some correction around this really speculative investing that is big? I mean, the dollars of magnitude here are huge, and there's got to be some kind of reckoning here, because you can't wake up and have returns like this for literally nothing. It's just it's puzzling, but we've been holding out for years watching it. So I don't know if it's going to happen in the next 12 months.
Wouldn't it be ironic if we issued a non-fungible token of Don's first 2021 prediction, and that made us all incredibly wealthy, right? We each took a share of the non-fungible token of Don Sheets, and we all got a yacht out of it.
Sheets coins.
That's it right there. Sheetcoin. Yep.
Coins.
Love it. Yeah.
So Don, today marks a year that we have been working from home technically, and obviously you have similarly been working from home. What are your thoughts about when your organization and the market at large is more normal?
Well, I don't think our organization will ever be normal, but
Ouch.
No, it's like a Dilbert.
From a working perspective.
No, I love my team. I love the organization. All good. So, officially it's July for us. We have a life insurance company that's 2 layers up of our parent co, which really is calling most of the shots that kind of trickle into what that might mean for our underlying portfolio business. So it's July. I know a lot of people are whispering now it's September. Our headquarters for Broadshore is here in Los Angeles, which was under a strict curfew ahead of Thanksgiving through early Jan. So it's at earliest July, and clearly rotational basis. I think it becomes probably a little elongated over the summer. And for me, I've actually found a lot more productivity in being remote than being in office, but I realize that clearly that's not sustainable. So there are a lot of real estate people out there, or financial services people out there that are insistent of, kind of this get back to office. And, I think ultimately I was a pretty old school thinker before this. It really took this to, change the mold of being able to be accessible at any time, anywhere, which has its pluses and minuses, and to have some of these technologies. I was on a plane every week. I don't think that's going to happen getting back once we're even back into a steady state. That bar is really high to invest that time and effort again. So there will be some of these changes that trickle through. I don't make wholesale guesses, but for our business, summer at earliest before any of us are kind of keying in to the office. And it certainly is not going to be Monday through Friday at that point.
I'm going to bet Labor Day. So
I bet Mother's Day 2020. How
Yeah,
far
you're
off
wrong.
was I?
yeah, you
I
were
was,
wrong. Yeah, your
I've
target
already
kept
been
moving.
off by about 10 months.
Yeah, so we'll see. We'll see who's right. And with that, we'll close this special podcast. Thank you to Donald Sheets from Broadshore Capital Partners, and thanks to our producer, Haley Keene. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question, send us an email at podcast@trepp.com. Please visit trepp.com for more info and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.